Well, the bet that was made in the strong dollar throughout most of this year was a bet made on the premise that policy uncertainty would continue in the U.S., that you would see reserve managers rotate out of the dollar, that this would be followed by private asset allocators, including fixed income allocators, move out of the dollar. It was also predicated on the richness of the dollar. We've seen a real appreciation of the dollar for the past 13 years. And that was a great story. And I think people made a lot of money betting on that weakness in the dollar until the last few weeks. What's happened in the last few weeks, I think, is not unusual. I think what has happened is that people have realized, traders have realized, that, hey, there's just as much political uncertainty and policy uncertainty in the rest of the world in some of these key markets as there is in the U.S. And the case in point, of course, has been Europe with the prospect that we may see a socialist become the prime minister of France, that we may see delay to pension reform, that we will see France not solve its deficit and debt issue, and of course now Japan as well, with concerns over whether or not this ruling coalition will maintain power and whether we go to early elections there, potentially parliamentary elections. So look, as long as the U.S. looked to be the only source of uncertainty, it was a weak dollar story. Now that the U.S. is not the only source of uncertainty, it becomes a strong dollar story again.
Does the U.S. dollar retrace that 8-9% decline it's had earlier
I
this year?
don't think so, although it's hard to predict the headlines coming out of the rest of the world, in part because the nature of uncertainty is that it becomes hard to predict. But I will tell you that the dollar had gotten so rich over the last 13 years and had gotten to a point 9 months ago where it was probably a level on sustainability in its valuation. I just don't see it getting back to the levels of February and March of this year.
Explain to those across America listening and watching why we should care about Japanese yen. I saw a couple really good essays on this yesterday, but I think it needs to be repeated.
Yeah, so look, if you're a stock market investor, and let's take this from the perspective of not a policymaker, but an investor, because I want to appeal to the readership here. If you are invested in Japanese stocks, and a lot of these stocks are multinational stocks, they sell very high value-added industrial products to the rest of the world, their operating margins benefit from a weak yen. So that's one reason why you need to pay attention to this. In fact, with the weakness of the yen that we've seen in the last few days, since the political turmoil, the stock market's done fantastically, which seems to suggest to me that the weakness in the yen is not so much a fundamental thing as much as it is a predilection on the part of investors to wonder, what is the central bank going to do? It's not about a weakening of the Japanese economy.
I was tackled by a Morgan Stanley guy yesterday, and we were talking about this. Dan Scully, he's a big Dan Scully fan. I thought Dan was on last time was great. And the guy said to me, he said, this yen is hugely destabilizing. In the heart of the matter, their wages have disappeared.
Yeah.
They're like England in 1930 in terms of real wages.
Terry, we got a government shutdown here in the United States. Is that going to affect our Federal Reserve here over the next several meetings, do you think?
Yeah, I don't think so. I mean, if what you're referring to is the premise that because of a lack of official data, the Federal Reserve will not know what to do, I would take issue with that. There's plenty of third-party data. The Federal Reserve itself conducts surveys. It collects data. It will have that at hand when the meeting takes place on October 28th and 29th to make an informed decision about where the economy is going. It doesn't rely just on official data. To say that you're data dependent does not mean that you're officially data dependent. It means that you're just data dependent. So I think they'll have enough data. Look, my view on the Fed is that there is a sufficient reason to believe that interest rate policy in the U.S. right now is not overly restrictive. If it were, we wouldn't be seeing the stock market at new highs. We wouldn't be seeing gold ripping. We wouldn't be seeing corporate bond spreads as narrow as they've gotten. I think the Fed needs to take all of that into consideration. If they do cut, it will be a very reluctant cut, I think, in view of what the financial markets have been doing.
So, I mean, is the cadence here of the Fed, is it meeting by meeting? Do you think they have a strategy of let's cut a couple times this year, then cut early next year, then we'll sit back?
If that, I mean, Jay Powell said on September 17th, I mean, practically admitted that the cut they made in September was an insurance cut. That seems to suggest that they're not necessarily on a path to cut 2 or 3 more times and wait. It really does suggest that the cut was only intended to strike a balance between the two mandates within the dual mandates a little bit better, and it does not imply a long and profound series of rate cuts.